Well, so far for 1990, high-yield bond prices have gotten off to a fairly good start, especially in yesterday's session, where we saw prices increase rather markedly from the previous day's close. Joining us now for an in-depth look at the latest action in the high-yield markets is Michael Kimball, with Chase Investors, who joins us from our studios in New York, and here in Los Angeles, Marko, who is with Houlihan, Lokey, Howard, and Zukin. Gentlemen, thank you for joining us. And Mr. Bujic, let me start with you this morning. Can you just characterize right now the state of the high-yield market? We have seen a great many of news items that have roiled that market in the past. The Campo worries, the situation at Integrated Resources, at Western Union, a variety of companies either defaulting or threatening to default on their high-yield securities. Things settling down a bit at this juncture?
I think things have settled down quite a bit. As a matter of fact, what we've seen is some strength come into the market, especially in the last few days of December, first couple days of January. And I would say that currently investors are still looking at this market and wondering when's the next shoe to drop. 2 or 3 shoes have already dropped, and they're still waiting for 4th and 5th shoes to drop. But at this point, you know, it looks as though most of the bad news that's out there has already hit the street, and possibly even more bad news than investors anticipated has already hit the street, so that if anything, we might see some good surprises coming up now. There really are probably has been an over-discounting by investors in 1989 for some of the problems, and right now, if some of this bad news does not come to light, we could actually see a reversal of some of the negative sentiment that built up in 1989.
Mr. Kimball, do you think there is another shoe to drop in the high-yield bond market, or is there some surprising news waiting in the wings?
Well, I think there are plenty of shoes to drop. It all depends on what happens in the economy in 1990. There are, in my opinion, so many LBOs that are on the brink. If the economy slows down dramatically or even goes into a recession, I think that'll push a tremendous amount of shoes dropping on the floor in 1990.
So you're not quite as sanguine as Mr. Bujic on the outlook for the junk bond market?
No, I'm not.
All right. We're going to take a quick break. When we come back, we will look at comparative yield differentials between Treasury securities and junk bonds, and we'll also get an outlook for the market from our 2 guests right after this short break. Stay tuned. We continue now our New Year look on the state of the high-yield or junk bond market. Joining us here in Los Angeles this morning is Marko with Houlihan, Lokey, Howard, and Zukin. And in New York, our guest is Michael Kimball of Chase Investors. And we continue now talking about the situation in the junk bond market, which for the first 2 days, gentlemen, of 1990 has been fairly strong. Mr. Bujic, let's take a look at the comparative yields now between Treasury securities and high-yield bonds. The chart that you provided suggests that in some ways investors are compensated for the risk that goes along with these securities?
Yeah, as a matter of fact, the issue that's the most important for investors looking at fixed income is how well are you compensated for the credit risk or the default risk in high-yield bonds. Currently, the average spread is probably about 700 basis points or so. And to put that into perspective, what you need to make you even is a default rate of about 8% a year. Over 10 years, 50% of your portfolio could default, and you would still come out with a better return than the 8% that you can earn on treasuries given today's yield in the high-yield market. All
right, Mr. Kimball, are you of the same mind, or do you think that might be stretching it a bit, if you will, in terms of trying to reason out a high-yield investment?
Well, I think the reasoning is sound. However, the problem I have with that reasoning is everyone looks at historic default rates and says historically it's been 2%, and therefore going up to 8% is just a tremendous jump. However, the market that exists today is not the same market that existed 5 or 6 years ago. 5 or 6 years ago, the market was dominated by fallen angels, investment-grade companies whose credit ratings deteriorated, and middle-market companies. Today's market is dominated by LBOs. And if you look at the credit quality of new issues over the past 5 years, one study by a guy named Barry Wigmore at Goldman suggested that fixed charge coverage of these new deals has gone from about 2 times in 1980 to 0.7 times in 1988.
Meaning specifically what?
Meaning that the new issues over the past few years have been of much poorer credit quality than the issues that were done 5 or 6 years ago.
Let me turn to Mr. Bujic for just a moment. Again, the default rate in 1989, too, seemed to accelerate from the pace set earlier in the decade. Does that worry you at all, given the age of the economic cycle right now in the U.S.?
No, it really doesn't worry me very much. And as a matter of fact, let me correct you, because the default rate in 1989, while I have not seen the final numbers, was actually very close to the historical default rate we've seen over this decade. The only difference in the defaults that occurred this year and the troubled companies was that they were larger companies and that people noticed them more. But we have a much bigger market. We have a $200 billion market. We didn't have a $200 billion market 5 years ago. We had a $50 and $100 billion market. I don't disagree with Mr. Kimball that the default rate will go up next year and in ensuing years, but it will not go up to the extent or to the level that the investors seem to have implicitly put into the yields of high-yield bonds. In other words, while we'll see a little blip up, I do agree, and probably this year as some of the larger troubled companies come home to roost, so to speak, it will not go up to the level needed to make junk bonds a bad investment.
Okay, let me just bring this news flash to bear here on the conversation. It seems appropriate. From Reuters, 29% of Campo's stock has just been handed over to the National Bank of Canada by a defaulting private company. Campo seems to be one of these cornerstone deals in the whole LBO situation. Mr. Kimball, if we see further fallout like this, in your estimation, should individual investors get involved with high-yield securities at all?
I agree with Mr. Buzek. Over the next 5 or 6 years, I think 8% defaults a year are not going to occur. But I just feel in 1990, we don't know how high the default rate is going to go, and I think there are many more shoes to drop, including Campo, Western Union, Southland, and many other LBOs that are on the brink. According to Drexel, in a mergers and acquisition newsletter, they view the restructuring market to be about $65 billion of high-yield debt. That's about 30% of the market. I think long-term high-yield bonds are probably going to be good investment, but I wouldn't suggest individual investors get involved right now.
All right, Mr.
There's
Buzek,
just too much uncertainty.
I'm going to give you the last word. We have about, 2-3 seconds left, so just a quick couple of ideas that you think are the best of the lot right now.
Currently, the best of the lot, my favorite would be Home Shopping Network. This is a company that has a debt-to-equity ratio of about 0.3 to 1, and it's buying its own bonds, is showing record earnings, and it's traded on the American Exchange, so individual investors can actually buy small pieces of it. I also happen to like Kroger. It's another good, solid company that's reporting excellent results.
All right, gentlemen, thanks very much. We have been speaking with Michael Kimball in New York of Chase Investors, and here in Los Angeles, Marko Buzek with Houlihan Lokey, Howard and Zukin on the state of the high-yield market. When we come back, we'll take a look at retail sales. FNN's Robert Metz will have more on his street news commentary right after this.